What if everything we thought we knew about stablecoins, these so-called crypto dollars, was completely backwards? Just 2 months ago, something happened in global finance that most people missed. But for those paying attention, it was like watching a nuclear warhead quietly detonate in slow motion. In early June, Circle, one of the world's major stablecoin issuers, went public on the New York Stock Exchange, grabbing front-page headlines in financial outlets for days. In just 2 weeks, its stock price exploded to $263, many times above its IPO price. But that was just the beginning. In mid-July, former President Donald Trump formally signed the first nationwide stablecoin regulatory framework, officially called the Genius Act, into U.S. law. This singular act marked the transition of stablecoins from a legal gray zone into full government recognition. And when we consider that Warren Buffett as Berkshire Hathaway had just exited positions in Citibank and slashed holdings in multiple major American banks, it all hints at something seismic. A once-in-a-century shift in financial infrastructure is underway. Do you think stablecoins are here to stay or just a passing trend? Let us know in the comments. This video walks you through the legislation, the players, the conflicts, and, ultimately, the global financial chess match that stablecoins just ignited. Because what's buried near the end of this video, it might very well reshape how you understand money, power, and digital sovereignty itself. In June, Circle rang the bell on Wall Street. For most companies, going public is financial news. But for a cryptocurrency firm, especially a stablecoin issuer like Circle, it was history in the making. Within days, Circle's valuation doubled, then tripled. Analysts scrambled. Investors speculated. But seasoned observers understood this wasn't just a stock movement, it was a signal. And then came July 18th. Trump, back in political motion, signed into law the Genius Act, short for Guiding National Innovation in U.S. Stablecoins. It passed swiftly, 68-30 in the Senate, and 308-122 in the House. No amendments, no delays. The requirements were sharp and clear. All stablecoins issued for payment must be backed 1-to-1 in reserve assets. Those reserves must be highly liquid, either in U.S. dollars, existing bank deposits, or short-term U.S. Treasuries. Only licensed entities registered in the United States are allowed to issue payment stablecoins legally. Offshore issuers? They must meet tight compliance standards. And you better believe enforcement is coming. This marked a tectonic shift. Stablecoins have officially entered the financial establishment. But not every issuer was ready or willing. Suddenly, words like accounts frozen and withdrawals blocked were no longer theoretical. Under the Genius Act, any exchange or wallet exposed to non-compliant stablecoin flows faced heavy scrutiny. Take OKX, for instance, one of the world's largest crypto exchanges. They began emphasizing compliance as their central operating principle, paying heavy fines to settle prior investigations with the U.S. Department of Justice, shutting down specific Web3 wallet services for re-audits, aggressively seeking licensing approvals in the U.S., EU, Singapore, and Dubai. By July, they'd secured a strategic partnership with none other than Circle, connecting USDC directly to their platform for seamless 1-to-1 fiat-to stablecoin exchange. That's not just PR. Since 2022, OKX has been publishing monthly proof of reserves audits, showing users that their platform sits on full backing. No more fractional shuffling of funds. If every user decustodied at once, no insolvency, no chaos. Why? Because in crypto, especially post-FTX, trust is no longer optional, it's structural. If you're still watching, you're not here for surface-level headlines. You want to understand the shift beneath the narratives. So click to follow our channel and turn the bell on. Enoch Report delivers in-depth insights the mainstream misses often when it matters most. For over a decade, one name dominated the stablecoin market: Tether, or USDT. Founded in 2014 during the depths of the Bitcoin winter, Tether's origin story reads like a spy thriller. Its parent company, Tether Holdings, is officially registered in the British Virgin Islands. Its operations base is Hong Kong. Its reserve bank, stationed in the Bahamas. But far from obscure, Tether became the most widely used stablecoin in the world. It resisted regulatory oversight like a ghost thriving in the shadows of international finance. So how does Tether make money? Simple. Users deposit fiat dollars. Tether invests those reserves mostly in U.S. Treasuries, repo markets, and money funds. The firm earns high-interest returns, especially lucrative in today's higher-rate environment. At one point, despite having only about 150 employees, the company reported over $13.7 billion in annual profits, more than Tesla or BlackRock. On a per-employee basis, it is arguably the most profitable entity in the financial world, but not everything is so clean. In Venezuela, USDT became the local lifeline. After the U.S. sanctioned its national oil company and froze its U.S. assets in 2020, the Maduro administration authorized crypto transactions to stabilize trade. Tether, being fast, global, and hard to trace, became their tool of choice. But it backfired. Without transparent traceability, billions went missing. Middlemen pocketed revenues. The oil minister resigned. Even former officials admitted the crypto network had facilitated deep levels of corruption. Still, for regular Venezuelans, it was salvation. In 2019, inflation in Venezuela hit 350,000%. El Dorado, a locally run peer-to-peer platform, emerged to help users convert salaries to USDT daily. Immigrants used it to send remittances home in seconds. It's not isolated. Russian defense contractors now use USDT to bypass Western sanctions, importing dual-use technology from abroad. Rubles are converted into Tether, sent to neighboring intermediaries, and then forwarded to suppliers. This is Tether's paradox: lifeline for the people, or tool for rogue regimes. Maybe both. By 2021, regulators began to catch up. Tether faced a $41 million fine from the New York Attorney General's office for misrepresenting its reserves. In some quarters, it held barely 27.6% of the funds it claimed. Then came the Bitfinex allegations. Though both firms deny links, multiple executives overlapped across companies. CFO Giancarlo Divicini held dual roles, shared servers. Interlinked reserves. At one point, Bitfinex reportedly borrowed $700 million from Tether's reserves to cover a liquidity crunch. And a landmark academic study from the University of Texas suggested that Tether issuance was timed to manipulate Bitcoin prices, deploying new USDT to prop up falling markets. It was explosive, but never criminally charged. On the other side sits Circle, the issuer of USDC, founded by Jeremy Allaire and Sean Neville. With roots in enterprise software and internet finance, Circle was built for compliance. From its day one in 2018, USDC was backed by Goldman Sachs, BlackRock, Fidelity, and Coinbase. Circle openly publishes reserve data, weekly, sometimes down to FDIC insurance status on custodian banks. Every USDC is fully backed by cash or short-term treasuries. But this transparency comes at a cost. Circle blacklists addresses under sanction directives, freezing funds when required. Critics argue this makes them a tool of state surveillance. Defenders say it makes them bankable, institutional, and legal. Hence the power duel. Tether's raw market efficiency versus Circle's legal acceptability. In 2020, the bickering went public. Circle's Allaire slammed Tether as unregulated and opaque. Tether's Divicini fired back: as long as USDT exists, Circle can't win. That may now be changing. Here's where it really gets interesting. Howard Lutnick, Trump's appointed Commerce Secretary, is also the chairman of Cantor Fitzgerald, a financial firm that manages Tether's reserve treasuries. In 2024, Cantor quietly acquired a 5% stake in Tether worth $600 million. Lutnick also hosted major fundraisers for Trump and was named co-chair of his presidential transition team. Shortly after Trump's win, Tether invested $775 million into Rumble, a conservative media platform, a deal again brokered through Cantor. And in Senate confirmation hearings, Lutnick defended Tether, stating that criminal actors used USDT simply because of its scale, not because it was dangerous. He cautioned lawmakers not to strangle blockchain-based dollar alternatives with overly burdensome regulations. Sounds like a coordinated defense of Tether's role in global crypto finance? Possibly because America needs it. Here's the big picture. Tether holds $120 billion in U.S. Treasuries. That makes it the world's 19th largest foreign holder of American debt, larger than Germany. Would Washington really blackball its own investor? Unlikely, in fact. With the Genius Act, U.S. stablecoins could become essential to American debt issuance itself. Standard chartered estimate stablecoin supply could hit $1 trillion by 2028, if even half of that is backed by Treasury holdings. It creates enormous buying pressure for USD TAT, almost zero political cost. That's digital dollar dominance on autopilot. This isn't just an American story. In the lead-up to the Genius Act, Hong Kong passed its own stablecoin licensing law. JD Finance and Ant Group began seeking licenses. In April, MasterCard added stablecoin settlement options for merchants. In May, Britain's FCA proposed formal rules for stablecoin issuance and crypto custody. South Korea's government began drafting its own digital asset legislation. By June, China's central bank governor openly addressed stablecoin policy at the Legalization Forum. From Singapore to India, from Australia to Japan's, similar legal frameworks are underway. Each country racing to defend its own monetary architecture, because the real risk isn't crypto, it's being locked out of the future of money. Here's the practical reality. If two businesses, say one in Germany and one in Brazil, do cross-border trade via traditional banks, the transaction can take up to 5 business days through SWIFT. With stablecoins, it settles globally in seconds. With lower fee, can even earn yield while idle. OKX is simple. Earn product, for example, matches lender and borrower demand for USDT. At market peaks, yields hit 50% APY. Even during flat cycles, 10% is common far beyond bank savings rates. Though the Genius Act prohibits direct interest payments in stablecoins, workarounds like these keep the demand steady and growing. Traditional banks see what's coming and they're not thrilled. Bank of America warned that stablecoins could result in a significant deposit flight from the banking sector. Even with full reserve requirements, banks lose flexibility. That hits credit flows, that hits stock prices. It could also explain why Buffett's Berkshire is quietly exiting the commercial banking space. Meanwhile, in inflation-prone countries like Argentina and Turkey, stablecoin penetration already tops 30%. Locals bypass local currencies entirely, using digital dollars to store wealth or survive. That's not just innovation, that's monetary insurgency. Stablecoins are no longer just speculative tools or crypto novelties. They are now a pillar of the next phase of finance, recognized by law, entangled with governments, and deeply embedded in trade. Finance is undergoing its next great unbundling. The lines between Wall Street and Silicon Valley, between monetary policy and distributed code, are evaporating. History often rhymes. In 1999, the U.S. repealed the Glass-Steagall Act, breaking barriers between commercial and investment banks. That led to the rapid formation of megabanks like JP Morgan Chase and Citigroup. Now in 2025, stablecoin laws are breaking the wall between finance and tech. Any firm with assets and licensing can issue a global payment token. Financial power is shifting away from legacy banks to code bases, cap tables, and blockchains. I want to hear from you. Are stablecoins the next financial revolution, or a monster we've invited in through the side door? Drop your comment below. We read everyone. And remember, if this brought you any insight today, subscribe and turn on the bell, because timing matters, especially in markets like these. This is Enoch Report. We'll see you in the next one.